Something just happened in the silver market that signals we're on the verge of the biggest commodity squeeze since 1980. On December 11, 2024, silver rocketed past $64 an ounce for the first time in modern history, only to get smashed back down to $62 within hours. Now, most people saw this as just another crazy day in the metals market, but what it really was the completion of Stage 3 in a 4-stage commodity explosion pattern. And we are about to enter Stage 4, the stage where raw mathematics becomes more powerful than any market manipulation. For the last 3 years, hundreds of millions of ounces of physical silver have literally vanished from global inventories. The COMEX warehouses, the supposed backbone of the paper silver market, now report less than 300 million ounces remaining. That's down from 400 million ounces just 2 years ago. To make things even tighter, China has announced a silver export ban starting in January 2026. This is happening while industrial demand is exploding. Solar panels, electric vehicles, and AI data centers are now consuming over 1.2 billion ounces of silver every single year. But guess what? Mine production is stuck at 850 million ounces. The math is screaming at us. We have a massive structural deficit that is draining physical stockpiles at an alarming rate. This isn't just a trend. It's as the final stage of the historical silver squeeze pattern, the explosion phase where scarcity overwhelms. Manipulation and prices don't just climb, they go vertical. I'm going to show you exactly how this pattern crushed short sellers 3 times in the last 50 years. We'll look at why experts like Lepard are targeting $75 by mid-2026, why major banks are now setting $100 price targets, and why this squeeze could be even bigger than the famous events of 1980 and 2011. Understanding this pattern isn't just about silver. It's about recognizing that moment when physical reality finally overpowers paper promises in any manipulated market. So let's break down the pattern. Stage 1 is the quiet setup, which happened from 2020 to 2022. Every commodity supercycle starts this way. The fundamentals, the real-world supply and demand, start getting worse and worse. But prices stay suspiciously low, often held down by paper contracts. During this time, the smart money quietly buys up the physical asset while everyone else is distracted. Back in 2020, the COVID pandemic permanently broke the silver market structure, but most people totally missed it. Global mine production fell by 7% as mines in Mexico, Peru, and Bolivia were forced to shut down. The exact same time, industrial demand went into overdrive. Governments pushed green energy, and solar panel installations doubled. Electric vehicle production surged 150%, and the need for data centers to support remote work and AI exploded by 200%. Each of these industries is a silver guzzler. Solar panels need 234 million ounces a year, EVs need 78 million, data centers need 41 million, and that demand is growing 37% every year. The numbers became impossible to ignore. We were using 1.2 billion ounces annually but only mining 850 million. That created a 350 million ounce deficit that had to be filled by draining existing stockpiles and from recycling. But stockpiles are finite, and you can't just magically increase recycling overnight. While retail investors were chasing meme stocks, the big institutions were making their move. JP Morgan, for example, accumulated over 1 billion ounces of physical silver between 2008 and 2020, all while helping to keep paper prices suppressed. It was the largest physical commodity accumulation in modern history. Bank of America and Goldman Sachs also started warning their clients about long-term silver deficits. When the biggest banks on Wall Street all quietly agree on something, it's time to pay attention. Stage 1 set the perfect trap. Artificially low prices, massive institutional buying, and a guaranteed future supply crisis. That brings us to Stage 2, recognition and early movement. This took place from 2023 through early 2024. This is when the wider market starts to wake up to reality. The price starts to climb, but slowly. It gives the illusion that things are still under control. But behind the scenes, panic was setting in. Industrial users started fighting for silver supplies. Solar panel makers were facing 3-month delivery delays, something unheard of in that industry. Electronics companies began buying their silver 6 to 12 months in advance, paying extra just to avoid shutting down their factories. In places like India, buyers were paying $7 over the spot price just to get immediate delivery. The market in Shanghai started trading at a higher price than London, a classic sign that the physical market is detaching from the paper one. When prices differ like that across the globe, it means real scarcity has arrived. Adding fuel to the fire, the Federal Reserve started cutting interest rates in late 2023. Lower rates make holding an unyielding asset like silver much more attractive, and it weakens the dollar, which is also bullish for metals. The conditions were now set for the next, more aggressive phase of the rally. We need to talk about silver, because what's been happening in the last few months isn't just another market rally. We're witnessing a fundamental shift, and it's accelerating faster than anyone predicted. Let's break it down into stages, starting with what just happened. We've been in Stage 3, the acceleration phase. This is where the smart money's moves become obvious to everyone. For For the past 6 months, institutional investors have been quietly piling into silver. Take the iShares Silver Trust, for example. In early December 2024 alone, it added a staggering 590 tons of silver, hitting levels we haven't seen since 2021, and it wasn't just them. Major ETFs like Aberdeen Standard and SPDR Silver Trust also saw record inflows. When all these huge funds move in sync, it's a massive signal. They see a multi-year supply shortage coming, and they believe higher prices are inevitable. Remember when silver climbed from $18 in 2020 to $32 by the end of 2023? That was a 78% jump. Most people dismissed it as a temporary blip caused by the pandemic. They were wrong. That was stage 2, the slow recognition that the supply chain was permanently changing. Now, let's talk about the technicals. Silver's breakthrough above $60 in November 2024, and then that spike to $64 in December, wasn't just about hitting a nice round number. These were resistance levels that have held for decades. Breaking through them opened the floodgates. Technical analysts pointed out that silver had been consolidating in a huge pattern since its 2011 peak of $49. The move past $32 in 2023 was the first signal of a new bull market. The $64 spike confirmed it. We're now in what some call a parabolic mode, similar to what we saw in 1979 and 2010, right before massive price surges. Momentum analysts are even suggesting that if silver can hold above $65, we could see prices push towards $100 or more within the next 12 to 18 months. But this isn't just about charts and patterns. The physical market is screaming tightness. By December 2024, COMEX silver inventories dropped to just 19.1 million ounces, the lowest level ever recorded. Think about that, 29 million ounces were drained in just 4 business days. That's 145 times the normal withdrawal rate. When the physical silver backing paper contracts disappears that quickly, those contracts become nearly impossible to honor. We saw silver lease rates, the cost to borrow physical silver, spike to 38% annually. Rates that high have only happened 3 times in the last 20 years, and each time it was followed by a major price rally of over 40%. The same inventory stress is being reported in London's LBMA vaults. When both of the world's major silver hubs are under pressure, you know the global supply situation is critical. Then came the bombshell announcement. In December 2024, China declared it would ban all silver exports starting in January 2026. This was the catalyst that pushed silver's acceleration into overdrive. China produces about 15% of the world's mined silver, around 150 million ounces a year. Removing that from the international market creates an immediate, massive global shortfall, and this isn't a temporary restriction. China needs every ounce it can get for its own strategic goals: solar panels, electric vehicles, and 5G infrastructure. The moment this news hit, industrial users started panic buying to secure their supply for the next few years, which only drained inventories faster and pushed prices through those key technical levels. So where does that leave us? We're entering what I call stage 4, mathematical inevitability. This is the phase where the numbers become so overwhelming that prices have to adjust, and they adjust vertically. 2024 ended with a record-breaking silver deficit of 280 million ounces. Projections for 2025 show another deficit of 150 to 200 million ounces, and that's before China's export ban even kicks in. Since 2021, the cumulative deficit is now over 800 million ounces. The world's above-ground silver stockpiles, which peaked at around 2 billion ounces back in the year 2000, have been steadily eaten away by industrial demand. Current estimates suggest less than 1 billion ounces are left in a readily available form. At the current rate of consumption, especially with Chinese supply being taken off the table, those remaining inventories could be completely exhausted in just 3 to 4 years. This isn't speculation, it's simple arithmetic, based on documented supply and demand figures. The physical reality is about to overwhelm the paper market. We are at a critical juncture for silver. The combination of institutional buying, technical breakouts, inventory collapse, and a massive supply shock from China has created a perfect storm. Make sure you're paying close attention to this market. Have you ever wondered what happens when an unstoppable force meets an immovable object? Well, we're about to find out in the global silver market. An explosion in industrial demand is on a collision course with a supply that simply can't keep up. This isn't just another market cycle. It's a fundamental shift that could send silver prices to heights we've never seen before. Let's start with the demand side. It's a three-headed monster that didn't exist in previous silver booms. First, solar panels. Deployment is doubling every 3 years, thanks to green energy mandates and falling costs. The International Energy Agency predicts solar capacity will increase 400% by 2030. This translates to a need for over 500 million ounces of silver annually, which is more than half of the entire world's current production, just for solar. Next up, electric vehicles. EVs are also on an exponential growth curve. Right now, they use about 78 million ounces of silver a year, but by 2030, that number could surge past 200 million ounces. And here's a key point: better battery tech isn't reducing silver use. In fact, the more sophisticated electronics in new cars actually require more silver per vehicle. And the third, newest driver, artificial intelligence. The massive expansion of AI data centers is creating a whole new category of demand. Today's data centers consume about 41 million ounces of silver, but as AI's computing needs explode, that could jump to over 150 million ounces by 2028. Add it all up, and we could be looking at a total industrial demand of over 1.5 billion ounces per year by the end of the decade. Now, let's look at the supply side. Can we just mine more? The answer is a resounding no. Unlike other commodities, silver production can't just ramp up when prices get high. Why? Because about 70% of all silver is a byproduct of mining for other metals like copper, lead, and zinc. Its production is tied to the economics of those base metals, not the price of silver itself. Even if we decided to fast-track every single proposed primary silver mine today, it takes 7 to 10 years to go from discovery to actual production. That means no significant new supply would hit the market until 2032 at the earliest. By then, the world could have a cumulative silver deficit of over 2 billion ounces. What about recycling? It only adds about 200 million ounces a year and isn't scaling up. Most silver is used in such tiny amounts in electronics that it's just not economical to recover. The math is simple. Demand is skyrocketing and supply is stuck. This deficit guarantees that existing inventories will continue to be drained, pushing prices higher. So, where are prices headed? Multiple analysts see a significant rise over the next 18 months. Bank of America has a $65 target for early 2025, driven by inventory depletion and the Fed cutting rates. Some technical analysts think if we see buying pressure from China, there's little resistance until the high $60s. Moving into mid-2025, we could see a breakout into the $70 to $80 range. If the supply deficit continues to grow, global inventories could fall to critically low levels, less than 2 months of consumption. When that happens in commodity markets, prices don't move gradually. They gapped up violently as industrial users panic and scramble for whatever is left. And beyond that, into late 2025 and early 2026, we could see a parabolic move towards $100 or even higher. If the mainstream media catches on and retail investors pile in, the buying pressure could become a self-fulfilling prophecy. Silver is a tiny market compared to gold, so even a small shift in investment can have a massive impact on the price. Some analysts are even whispering about $150 or $200 if momentum builds, similar to what we saw in the late 70s. But here's the most important part. This time is different. The previous silver spikes in 1980 and 2011 were driven by speculation and monetary fears. Today, the driver is real, physical, industrial demand. In 1980, demand came from photography, which was easily replaced. Today, solar panels and EVs have no viable substitute for silver. In 2011, there were plenty of above-ground inventories. Today, those inventories are being rapidly depleted. This isn't a speculative bubble. It's a structural supply crisis. Industrial users aren't speculators. They are permanent buyers who need silver no matter the price. The stage is set for a historic run in the silver market. What if I told you the single biggest difference in this commodity cycle is something most people are completely missing? It's called demand inelasticity. Think about it. Solar panel makers are going to switch to a less efficient metal and compromise their products just because silver hits $80 or $100. The same goes for electric vehicle producers. They'll absorb the higher costs before they ever consider using a substitute that degrades performance. This is the exact opposite of a typical commodity cycle. Normally, when prices go up, demand goes down. But with silver, the industrial demand just keeps growing, even as prices skyrocket. Now, you might hear some analysts talk about technology. They'll say, oh, new tech will reduce the amount of silver needed in solar panels by 10 or 15% over the next decade. And they might be right. But here's what they're not telling you. The overall growth in solar installations is projected to be over 300%. So even with those efficiency gains, the net consumption of silver from the solar industry is still going to increase dramatically. For other high-tech applications, substitution is basically impossible. Silver has the highest electrical and thermal conductivity of any metal, plus unique antibacterial properties. You simply can't replace it in most high-performance uses. This leads us to the next critical point, a coming liquidity crisis. The silver market is tiny. I mean microscopically small compared to stocks or bonds. The total value of all the silver mined in a year is around $50 billion. To put that in perspective, Apple's daily trading volume can easily surpass that. So what happens when big institutional investors, like pension funds, start waking up and decide to allocate even a tiny fraction of their assets to silver? If they allocated just 2%, the demand would outstrip the entire global production for decades. The available supply would just vanish. And this brings us to the COMEX, the main futures exchange. It's facing a potentially catastrophic situation. Right now, there are contracts out there claiming ownership of over 600 million ounces of silver. The problem, there are only about 19 million ounces of actual physical silver in their vaults to back those claims. As more and more contract holders decide they want the real metal, not just the paper, the exchange will be forced into a corner. They'll either have to let the price go to the moon to attract new physical deposits, force people to settle for cash, or just declare force majeure and halt trading. No matter which way it goes, it's incredibly bullish for the price of physical silver. So, how can you position yourself for what's coming? First, there's accumulating physical silver coins and bars you hold yourself. This gives you direct exposure with no counterparty risk. Yes, you have to think about storage, and there's a premium over the spot price, but think of that premium as insurance. Second, you can use silver ETFs for more liquid exposure, which is great for tactical trading, but remember there's counterparty risk if the financial system gets shaky. And third, for those with a higher risk appetite, there are silver mining stocks. These offer leveraged exposure to the silver price. If silver does hit $100 or more, the returns on these stocks could be absolutely explosive, though you have to be aware of operational risks. Every major commodity squeeze in history has created a massive transfer of wealth. It moves from the unprepared to those who saw the writing on the wall. By recognizing the pattern early, you can accumulate assets before the supply crisis becomes front-page news. You can use a pullback in price as an opportunity to add to your position, not as a reason to panic sell. This silver squeeze represents one of the most asymmetric risk-reward opportunities I've ever seen. The downside seems limited, but the upside could be 5 or even 10 times your initial investment. Let's look at a possible timeline. Based on how fast inventories are being depleted, things could get very interesting very soon. Imagine a scenario where by early 2026, a major silver exporter halts shipments, instantly taking a massive amount of supply off the market. Industrial users would start panic buying to secure whatever they can. As prices push past $80 or $90, the mainstream media frenzy begins. That's when the retail investor FOMO kicks in, driving that final parabolic move toward and beyond $100. This whole situation is a battle of physical reality versus financial manipulation. For years, paper contracts have suppressed the price, but you can't argue with physics and math forever. The numbers don't lie, and they're pointing to a historic move in silver. Did you know you can't make solar panels with paper contracts? You can't power electric vehicles with financial derivatives. And you definitely can't run data centers on futures positions. Real industries need real, physical metal, and physical silver is disappearing faster than it can be replaced. This is setting up a massive commodity squeeze, and we're just entering the final stage. The breakout past $64 was just the beginning. The question isn't if silver will hit $75 or $100. The math guarantees it. The real question is, will you be positioned before the rest of the world catches on? This isn't about opinions, it's about the undeniable force of supply and demand. The pattern is clear, the numbers don't lie, and the biggest silver squeeze in decades is happening right now. Don't miss what's coming. Thanks for watching and subscribe for more insights.